Hey everyone, it's nice to see you again. So in today's video, I want to cover why is the stock market reacting so erratically? Why is it like crashing right now? Given that all the tech stocks had amazing blowout earnings last Friday. Facebook, Google, Amazon, all of them had amazing earnings last Friday, yet the stock market is like right now. So I want to cover what are my thoughts. Why is the stock market like behaving so erratically? I also want to cover what I see as potential opportunities in the FANG stocks like right now. We're going to do a deep dive into the metrics. And of course, if you are looking to make a position in these stocks, in the FANG stocks in the upcoming weeks, or you're just interested just watching this video, then you gotta stick around. Hey everyone, if you are watching this channel and haven't subscribed, then why not? It's free. So please hit the subscribe button and that bell notification button so you get the latest and greatest videos coming to you. So why is the stock market reacting so like crazy given that the tech stocks had amazing earnings as of last Friday? Like I said in the last few many videos so far, and especially one of my first videos, we are in a situation, obviously we're in exceptional circumstances, and given the obvious reason, which is like the cases rising all around the world, in fact some countries are facing actual lockdowns, it's causing like people to fear like what's going to happen over the upcoming months. So people are just wanting to get they're moving their money from high growth stocks and probably putting into more safer stocks, like locking in the growth and gains that they had already and moving it to somewhere else. Other obvious plays are, we got elections coming up. It's always near year end where there's a lot of volatility, and that's a lot of institutions, a lot of investment funds need to sell off. They need to always get lock in their gains because that's their job. And so when they sell, they need to actually sell off the stocks that have already made the gains, and then they need to get their performance bonuses. So that's what we're seeing right now, a lot of bit of selling also from that side, which is like not surprising because it always happens around this time of the year. Another play is that we've got stimulus ending, like we've got a lot of the government intervention kind of ending right now, although depending on the upcoming weeks we could be getting more stimulus and government intervention, but right now it's ending. So that's also causing a bit of reaction in the stock market. Now, what are my thoughts about the stock market kind of, correcting right now? I would say I wouldn't be surprised if the stock prices actually go down 5 to 10%, if so like 15%. I'm super not surprised. I mean, it's just part of the game. And actually when I see that, I actually get way more excited because then there's more opportunity. Because if you are a long-term investor, I hope you are, that's why you're watching this channel, and you're looking to buy these stocks for 3 to 5 years, if not 10 years, if not forever, like in my case, I'm holding these stocks forever and planning to actually pass on a lot of the good stocks to my kids. And I'm looking at it from a very long-term perspective. So when I see short-term kind of volatility like that, in the grand scheme of the time span I'm investing, it's kind of just little bit of a blip. So what does this all mean? The reason why I'm kind of really wanting to do this video is because I want to say, hey, I'm a big tech investor and maybe there's opportunity. I'm looking at this like opportunity. So I'm going to dive into the metrics, the valuations between Google, Amazon, Facebook, Apple, and see where could there be opportunity. So when I look at, and we're going to do a bit of, all these things I'm going to go over is found in Yahoo Finance. It's for free under statistics. So when I look at the return on invested capital, we see Amazon's actually 13.3%. Google's 18.7, Facebook is 17.7, Microsoft's 23.5, and Apple's 31.8. Now, what does return on invested capital mean? It means how well is the company using its funds, reinvesting into profitable investments in the company. So essentially is like how well is management running? It's called management effectiveness. So how well is the company using their own money in the company to generate return? So you can see that Amazon is the lowest out of the bunch, while Apple is the highest return on invested capital. Now this is based on past. Okay, now let's look at forward price per earnings. Now this is a very popular valuation metric, which is comparing a stock price relative to how much it's earning, which is found in Yahoo Finance under statistics. We've got Amazon is 57, we got Google 27, we got Facebook 25.38, we got Microsoft 30.77, and we got Apple at 29.85. So what does this all mean? Okay, typically with higher price per earnings, it's kind of like, boo. You can see that the higher it is, the kind of like the premium people are willing to pay for that stock price. So you can see that Amazon is the most expensive one out of the 5. And we got the cheapest one being Facebook. And that's really, 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 really interesting. So not only Facebook has pretty good return invested capital, but it's got definitely the lowest out of the 5 right now. What does this all mean? This means that people are willing to pay premium for Amazon and not so much of a premium to Facebook. That's really what it means. Okay, when it comes to PEG ratio, now this PEG ratio is for the next 5 years. This is where it gets really, really interesting. Okay, the PEG is like just comparing its stock price relative to its growth rate. So if a company is growing really, really fast and its stock price is at a certain price, anything under 1 is like, wow, like it's looking like it's pretty cheap. That's just a simple metric to compare companies within, like say I'm comparing tech companies with tech companies right now. Well, anything over 1, yeah, it's okay. It's getting a bit more expensive. Anything under 2 is like, I don't know, that's like really, really, really expensive. But that's how I'm looking at the PEG ratio. So when I look at Amazon 1.17. That's getting really interesting. Look at Google, 1.45. We got Facebook, 0.95. Wow, like 0.95. Okay, I'm getting excited. Okay, Microsoft, 2.4. Apple, 2.84. So what does this all mean? In the PEG ratio, it's showing Facebook and Amazon are the 2 winners out of the 5 tech plays right now. Okay, so that's getting really, really interesting. Okay, well let's confirm its earnings growth and its sales growth for next year. And again, this stuff you can find on Yahoo Finance. So Amazon, you can see that Amazon's 39%. So next year, analysts are expecting that its average earnings growth is going to be 39%. Okay, that's pretty high. Wow, like 39%. This company is huge, and yet it's going to grow at 39%. It's like, wow, that's crazy. Okay, now Google got 27%. Like I said, like in my last video, Google is just one of those predictable growing monsters, and it keeps growing. It just does its thing. Look at Facebook. We got 25%. Pretty good. That's really good actually for a tech company. And then we've got Microsoft, 10%. No surprise there. It's a huge tech titan already. I mean, so huge. 10% is still pretty good. I mean, Microsoft is I think the oldest tech company out of the 5 right now. So 10% is awesome for Microsoft. And then we got Apple at 20%. Now, actually, I was super surprised. I saw Apple, where analysts are expecting on average 20% growth next year. And I thought, why is that? Oh yeah, I forgot, because of the super cycle for the iPhones. Like I said in my video up here, where you can check out the video about Apple if you want to know more about Apple. Okay, so when it comes to sales revenue growth, I mean, like earnings is really the bottom line growth. After all, they do the accounting gymnastics, deducting expenses, taxes, and interest and all that, and then boom, it's like the net income. And then you look at sales growth, which is like basically like, what is this revenue? What is this revenue growth? Which is like the top line. And so you can see Amazon's 18.3%. Okay, pretty good. Google 20.6%. Facebook 24.4%. And then we got Microsoft at 10.9% and Apple 14%. So again, Amazon, Google, Facebook, whoa, those are the winners when it comes to sales revenue growth for next year. This is pretty obvious. The Amazon and Facebook are the 2 big plays. I mean, Google's there. I'm really interested in Google. I did a video up here, but I mean, I already made bigger positions in Google already. And because of the legal lawsuit coming up, I'm kind of holding back a little bit, just kind of like sitting there. I will dollar cost average, but no big positions right now. I would say Amazon, Facebook are going to be definitely the 2 winners out of the 5. And given Amazon's growth, which is insane, 39% next year, and with a PEG of only 1.17, that's really, really, really interesting. And Facebook, which is the cheapest one out of the 5 tech stocks right now, that is like, wow, 0.95, a PEG, and an earnings growth at 25% with a price per earnings at 25. It's like, the metrics just blatantly tell you like, whoa, Facebook is definitely the cheapest value stock out of the tech stocks right now. But what are some of the biggest obvious risks? Well, big one is Facebook. They got the lawsuits as well. Also, I would say Mark Zuckerberg is kind of the risk to Facebook. I mean, I think there's some ethical plays here, so that's probably why maybe Facebook is not trading at such a premium. That could be it psychologically, but yeah, that's pretty much it. I think that's like, well, I'm speculating. This is me speculating, but I would say Amazon. I'm so surprised. Like I know Amazon is so expensive. It's like over $3,000, depending on the day it is, trading per stock. But if you could save up the money and start, I know in the US you could buy fractional shares. Just do it, because I mean, if you're a long-term investor like me, willing to invest like for at least 3 to 5 years, if not for a long time, if not basically passing on the stocks to your kids, than what's right now in the grand scheme of things. So try to save up as much money as possible. Cash is king right now, having cash on the side so you can jump on opportunities like this. I would say Amazon is the #1 play right now, and then Facebook is #2. I actually love Oculus Quest, which is what that got me really interested in Facebook, because they are trying to change their business model from more like social media to like gaming and all that. And I see a lot of revenue potential in gaming. And of course, with them monetizing WhatsApp, Instagram Reels. So there's a lot of like areas where Facebook could definitely grow their revenue. But my biggest hesitation is Mark Zuckerberg. That's really it. I'm going to just blatantly say that. Well, Amazon, I'm like, wow, that's just the metrics alone. I would say Amazon's it. Anyways, I hope you found this video super helpful. If so, give me a thumbs up. I hope by going through the process of evaluating tech stocks, using things that is widely available right now, running like a quick valuation, just basically comparing the metrics. I hope you I helped you make an informed decision, because what I'm going to do right now is start buying a bit more Amazon, save as much money as I can to buy more Amazon. And when there's more opportunities, which I'm expecting to see more red in the stock market. And of course, dollar cost average into Facebook. And that's how I'm going to play my positions. And of course, given the uncertainty over the next few weeks and months, definitely going to be holding more cash than usual, just so that I could jump on opportunities like this, what I'm seeing in the tech stocks. And let me know in the comments below, what did I miss? Did I miss anything that you would have used to value the companies? This is just a simple, easy peasy way to quickly value companies, comparing to each other. And then that's how I found the value plays and opportunity. Anyway, I'll see you in the next video.